Most crypto investors approach portfolio construction completely backwards. They pick individual coins they like, throw them together, and hope for the best. But professional asset managers and institutional investors use a completely different approach. They start with strategic asset allocation, consider correlation and risk factors, and build portfolios designed to maximize risk adjusted returns over time. In this comprehensive guide, I'll teach you the systematic framework that institutions use to construct crypto portfolios so you can invest like a professional rather than gambling like an amateur. Before diving into specific techniques, let's understand the fundamental philosophy that separates professional portfolio management from amateur coin picking. Strategic asset allocation first. Professional investors start with the question: how should I allocate my capital across different types of risk and return opportunities? They don't start by asking which specific coins to buy. The allocation decision, what percentage goes to large cap versus small cap, DeFi versus infrastructure, etc., determines most of your long term returns. Risk adjusted return optimization. Amateur investors focus on absolute returns. This coin went up 500%. Professionals focus on risk adjusted returns. This portfolio generated 40% returns with 25% volatility, giving a Sharpe ratio of 1.6. The goal isn't to find the highest returning asset, but to find the optimal combination of assets that maximize return per unit of risk. Diversification as risk management. Proper diversification isn't about owning lots of different coins. It's about owning assets that behave differently under various market conditions. True diversification reduces portfolio volatility while maintaining return potential. Time horizon and rebalancing. Professional portfolios are built with specific time horizons and systematic rebalancing schedules. This removes emotion from buy sell decisions and ensures the portfolio maintains its strategic allocation over time. Effective portfolio construction requires understanding the different types of crypto assets and how they behave in various market conditions. Store of value assets, Bitcoin category. Primary example, Bitcoin, BTC. Characteristics: lower volatility, institutional adoption, digital gold narrative role in portfolio. Core holding, defensive position, inflation hedge. Typical allocation: 30-50% for conservative investors, 20-30% for aggressive smart contract platforms. Layer 1s. Examples: Ethereum, ETH, Solana, SOL, Cardano, ADA, Avalanche, AveX. Characteristics: platform risk, network effects, developer ecosystem growth. Role in portfolio: growth exposure, technological infrastructure plays. Typical allocation: 20-40% across multiple platforms, DeFi and financial services. Examples: Uniswap, UNI, Aave, Aave, Compound, CoMP, MakerDAO, MKR. Characteristics: revenue generation, protocol fees, regulatory risk role in portfolio. Yield generation, financial disruption exposure. Typical allocation: 10-20% across multiple protocols, infrastructure and scaling solutions. Examples: Chainlink, Link, Polygon, Matic, Arbitrum, ARB. Characteristics: network utility, adoption based value, technical risk role in portfolio, picks and shovels approach supporting infrastructure. Typical allocation: 5 to 15% in specialized infrastructure plays emerging sectors, gaming, AI, privacy, etc. Examples: varies by current market trends and innovations. Characteristics: higher risk, short reward, early stage adoption, sector specific risks. Role in portfolio: speculative growth, emerging trend exposure. Typical allocation: 5 to 15% across multiple emerging sectors. Professional portfolio construction requires understanding how different assets move relative to each other and to external factors. Correlation analysis in crypto. Despite appearing diverse, many crypto assets are highly correlated, especially during market stress. Understanding these correlations is crucial for true diversification. Bitcoin correlation. Most altcoins have 0.7, 0.9 correlation with BTC during bear markets, sector correlation. DeFi tokens often move together regardless of individual fundamentals. Size correlation, large cap versus small cap. Cryptos behave differently during various market phases. External correlation, how crypto correlates with traditional markets, stocks, bonds, commodities. Risk factor, decomposition. Professional investors analyze the underlying risk factors driving returns. Market risk, overall crypto market direction. Technology risk, smart contract bugs, protocol failures. Regulatory risk, government policy changes. Liquidity risk, ability to exit positions quickly. Concentration risk, overexposure to specific protocols or ecosystems. Volatility assessment, different crypto assets have vastly different volatility profiles. Bitcoin, typically 60-100% annualized volatility. Large cap altcoins, often 80-150% annualized volatility. Small cap altcoins can exceed 200-300% annualized volatility. Stablecoins, near zero volatility but with deep peg risk. Stress testing. Your portfolio, analyze how your portfolio would perform under various scenarios. Crypto winter scenario, 80% decline across all assets. Regulatory crackdown, specific sectors heavily impacted technology failure. Major protocol hack or failure. Traditional market crash, stock market decline affecting crypto. Here are several proven allocation frameworks that you can adapt based on your risk tolerance and investment goals. The core satellite approach, core 60-80%, large cap, established cryptocurrencies, BTC ETH, satellite 20 to 40%, smaller positions in higher risk reward opportunities. Advantage provides stability while allowing for growth potential. Best for most investors seeking balanced exposure. The barbell strategy, conservative positions, 70-80% Bitcoin and stablecoins. Aggressive positions, 20-30%, high risk, high reward altcoins. Advantage, limits downside while maintaining upside potential. Best for risk averse investors who want crypto exposure. The equal weight approach, equal allocations across selected asset categories. Regular rebalancing maintains equal weights. Advantage, removes timing and selection bias. Best for investors who want broad, unbiased exposure. The market cap weighted approach, allocations based on relative market capitalizations. Automatically adjusts as market values change. Advantage, reflects market consensus on relative values. Best for passive investors seeking market returns. The factor based approach, allocations based on specific factors, value, momentum, quality, etc. Quantitative screening for factor exposure. Advantage, systematic approach based on historical return drivers. Best for sophisticated investors comfortable with factor investing. Custom allocation examples, conservative portfolio, lower risk. Bitcoin, 50% Ethereum, 25% large cap altcoins, 15% stablecoins, 10% balanced portfolio. Moderate risk, Bitcoin, 35% Ethereum, 25% DeFi protocols, 20% infrastructure, 10% emerging sectors, 10% aggressive portfolio. Higher risk, Bitcoin, 25% Ethereum, 20% DeFi protocols, 25% small cap altcoins, 20% emerging sectors, 10%. Determining appropriate position sizes is where most investors make critical mistakes. Here's the professional approach, risk budgeting framework. Instead of thinking in dollar amounts, think in risk units. Total portfolio, risk budget. How much volatility can you tolerate? Individual position risk. How much can each position contribute to total risk? Correlation adjustments. Reduce size for highly correlated positions. Concentration limits. Maximum percentage in any single asset or sector. The Kelly criterion for crypto. For sophisticated investors, the Kelly criterion can optimize position sizes. Formula F BP Q. B where F power fraction of capital, B bars odds, P R's win probability, Q R's loss probability. Requires historical data on win rates and average win-loss sizes. Often modified, fractional Kelly, to reduce concentration risk, volatility adjusted position sizing. Adjust position sizes based on individual asset volatility. Higher volatility assets get smaller allocations for the same risk contribution. Use historical volatility or implied volatility measures. Regularly rebalance as volatility changes. Consider volatility clustering in crypto markets. Liquidity considerations. Position size must consider your ability to exit. Smaller positions for illiquid, low volume assets. Larger positions for highly liquid assets like BTC and ETH. Consider market impact when planning position sizes. Maintain adequate cash reserves for rebalancing. A portfolio without a rebalancing strategy is just a collection of assets. Professional rebalancing maintains your strategic allocation and can enhance returns. Rebalancing approaches: calendar, rebalancing fixed schedule, monthly, quarterly, or annually. Advantages: simple, systematic, removes emotion. Disadvantages: may miss optimal rebalancing opportunities. Best for most retail investors seeking simplicity threshold. Rebalancing. Rebalance when allocations drift beyond set thresholds, e.g., plus 5%. Advantages. More responsive to market movements. Disadvantages: requires more monitoring and transaction costs. Best for active investors comfortable with frequent adjustments. Volatility based rebalancing. Adjust rebalancing frequency based on market volatility, more frequent rebalancing during high volatility periods. Advantages: adapts to market conditions. Disadvantages: complex to implement systematically. Tax efficient rebalancing. Consider tax implications of rebalancing decisions. Use new contributions for rebalancing when possible. Harvest tax losses strategically. Understand crypto tax treatment in your jurisdiction. Implementation. Best practices: use limit orders rather than market orders for rebalancing. Consider transaction costs in rebalancing decisions. Rebalance during periods of high liquidity. Document your rebalancing rules and stick to them. Track rebalancing impact on portfolio performance. For sophisticated investors, these advanced techniques can further optimize portfolio construction. Risk parity approaches: equal risk contribution from each asset rather than equal dollar allocation. Uses volatility and correlation data to determine optimal weights. Can improve risk adjusted returns in volatile markets like crypto. Requires sophisticated calculation but can be implemented with spreadsheets. Black Litterman model. Adaptation: starts with market cap weighted allocations, adjusts based on your specific views and confidence levels. Particularly useful for expressing views on specific sectors or assets. Requires statistical knowledge but provides systematic framework. Factor exposure management. Identify common factors driving crypto returns, market size, momentum, etc. Construct portfolios with desired factor exposures. Can help explain portfolio performance and guide future allocation decisions. Useful for institutional investors or sophisticated retail investors. Alternative risk measures: value at risk, VAR. Maximum expected loss over specific time period. Conditional VAR. Average loss in worst case scenarios. Maximum drawdown, largest peak to trough decline. Useful for setting risk limits and stress testing portfolios. Dynamic hedging strategies. Using derivatives or correlated assets to hedge portfolio risk. Option strategies for downside protection. Pairs trading within crypto to reduce market risk. Requires advanced knowledge and access to derivatives markets. Professional portfolio management includes systematic monitoring and performance evaluation. Key performance metrics: absolute returns, total return over various time periods, risk adjusted returns, Sharpe ratio, Sortino ratio, Kalmar ratio, benchmark comparison, performance versus relevant crypto indices, maximum drawdown, largest decline from peak to trough, win rate, percentage of profitable rebalancing periods. Portfolio attribution analysis, asset allocation effect, return from strategic allocation decisions. Selection effect, return from choosing specific assets within categories. Interaction effect, combined impact of allocation and selection decisions. Helps identify which decisions drive performance. regular portfolio reviews, monthly performance review against benchmarks, quarterly strategic allocation assessment, annual comprehensive portfolio audit, document lessons learned and potential improvements, performance tracking tools, spreadsheet templates for basic tracking, portfolio management software for advanced analytics, blockchain analytics for detailed on chain analysis, professional tools like Bloomberg Terminal for institutional level analysis, benchmark selection. Choose appropriate benchmarks for your strategy. Consider broad crypto market indices. Create custom benchmarks for specific allocation strategies. Track relative performance to understand added value. Learn from the most frequent portfolio construction errors. Over diversification. Owning too many similar assets that don't provide true diversification. Solution. Focus on correlation, not just number of holdings. Optimal portfolio size, usually 15 to 25 positions for most investors. Under diversification, concentrating too heavily in single assets or sectors. Solution, set maximum allocation limits, e.g., no more than 25% in any single asset. Consider correlation clustering during market stress. Emotional rebalancing, abandoning systematic rebalancing during market extremes. Solution, write down your rules and commit to following them. Consider automation tools to remove emotional decisions. Ignoring transaction costs. Frequent rebalancing can erode returns through fees. Solution, factor costs into rebalancing decisions. Use threshold based rebalancing to reduce unnecessary trades. Lack of documentation, not recording the reasoning behind allocation decisions. Solution, maintain detailed investment thesis and decision logs. Regular reviews help improve future decision making. Professional portfolio construction is one of the most important skills for long term crypto investment success. While it requires more effort than random coin picking, the improved risk adjusted returns make it worthwhile. Here's how to implement what you've learned. First, subscribe to this channel for more institutional level crypto education that focuses on systematic professional approaches to cryptocurrency investing. Second, start by assessing your current portfolio using the frameworks we've discussed. Calculate your current allocations, correlation exposure, and risk metrics. Finally, share in the comments what your biggest portfolio construction challenge is. Whether it's determining appropriate allocations, managing rebalancing, or tracking performance, I'll provide specific guidance. Remember, portfolio construction is both an art and a science. The frameworks provide structure, but you'll need to adapt them to your specific situation, risk tolerance, and investment goals.